Okay guys, so we're continue with investment banking. And we have 7 functions. First one is investing, as in fund management. Same as investing. Second is investment banking. It's more like issuing securities, including stocks and bonds. Number 3 is market. Making, and market making could be agency transactions or principal transactions. They could act as brokers, or they could act as dealers. Number 4 is trading, and I covered 4 of them. Position trading, where it takes maybe a few weeks of a certain position. Number 2 will be pure arbitrage. In pure arbitrage, you are trying to find the same security on 2 different markets with a different price and sell on the market with the higher price and buy on the market with the lower price. Example of a pure arbitrage will be, let's say gold is cheaper here, $1,190, and gold is more expensive over there, let's say in Singapore, 1,240. You buy the gold from here, sell it in Singapore. You also have risk arbitrage, which is not an arbitrage, it's an expectation of some kind of event to occur, and you bet that that event will move the stock or the security in a particular direction. Now, risk arbitrage is an event. It applies to stocks as well as bonds. And it applies to commodities. For example, you have an oil, you got OPEC meeting, OPEC will meet, and maybe you expect that OPEC, Saudi Arabia and Russia will decide to cut output, and as a result you expect oil price to go up again. So it doesn't mean stocks, it could mean as well currencies. For example, Bank of Japan might decide that the Japanese yen is too strong, and they may institute or introduce an extra monetary policy which is designed to weaken the yen. Okay? So it applies to stocks, bonds, it applies to commodities and currencies. It could possibly apply to real estate, but it's a lot trickier with real estate. And you can have program trading. Number 5 is cash. Management. The big financial innovation here is the CMA, the cash management account, which is kind of like a deposit, but not legally a deposit. And therefore, the investment bank can now function just like a commercial bank, okay, accepting deposits, meaning this is not a deposit. It accepts money which functions like a deposit, but it's not legally or technically a deposit. And suddenly, the whole difference between commercial banks and investment banks is blurred. An investment bank begins to function as a commercial bank, okay? And suddenly has some competitive advantage over commercial bank. Now, the CMA is not guaranteed by deposit insurance, which means that commercial banks do have competitive advantage because they can attract more deposits at a lower cost, okay? So, but nevertheless, this means that now investment banks enter into the big field of commercial banking functions. 6 is mergers and acquisitions. Trick. 6. A merger is like a marriage between two companies. Merger implies that they get together. Hopefully, the two companies will be more valuable than each company separately. So the sum total will be better. This, I think I've discussed, is called synergy. Synergy is the effect of creating value when two companies together is more than the sum of two companies separate. Well, the most common synergy that we all exploit today is called the marriage. A man can do his own things, and of course a wife can do her own things, but being together, working together, the value is significantly higher for both of them, and of course jointly. So in mergers, the main idea of a merger is that it is between two equals. In an acquisition, one company acquires another company. In other words, in an acquisition, one company is dominant company, and the other company is subordinated. And the second company becomes part of the first company. That's an acquisition. And an acquisition could come in the form of a takeover. In a takeover, the shares are public, and the acquiring company acquires a significant amount of shares and gains control of the acquired company. And they gain control whether the acquired company likes it or not, whether the management of the acquired company approves or not. So, mergers and acquisitions early on could be hostile where the acquiring company uses legal methods and force, mostly the power of money to acquire the other company. The other company resists but doesn't have the financial, economic and other means to actually defend itself. And the alternative is to be friendly. In which the company, the other company that is being acquired, we call it the target company. Target company. Cooperates. So the difference between hostile and friendly, that's a question for the quiz, is that in a friendly merger or acquisition or takeover, the friendly management cooperates. In the hostile, the friendly does not cooperate. It's the opposite. It resists the merger or the acquisition. Let's see what else we got here. So, what do? What the investment banks do? Number one, provide advice. So, the main function in mergers and acquisitions for an investment bank is to provide advice. Mergers and acquisitions are phenomenally complex. Investment banks will have actually some of the world's financial, economic best lawyers. So it will provide legal advice. You need lawyers. These things are legally tricky. They're not simple. They're not easy. They're complicated. You need good lawyers. Well, investment banks pay usually the best kind of money and can hire the best lawyers in the field. So, once you got a merger, the investment bank provides legal advice. Next, it's going to provide financial advice. Well, in a merger or acquisition, either way, there's got to be a payment. So the investment bank will try to figure out what is the best way to pay, how to pay best. So this is just an advice. They tell you, we advise you, or according to our best expertise, it's best to pay with cash, or it's best to pay with bonds, or it's best to pay with stocks, or it's best to pay whatever form. So they'll provide financial advice, and they'll also provide, which is half legal, half financial, will provide accounting advice. A lot of times, how the deal is going to look in accounting will depend critically on the legal part and will depend critically on the financial part. And how the accounting books will look is very important, okay? And finally, part of the legal and part of the accounting part, they'll provide another very special advice, which is tax advice and tax consulting. All right? Number two. Finding merger partners. Of course, the acquiring company may already have a merger partner in mind. They may be already looking at that particular company, which they like for whatever reason, and they'll maybe contact the company itself, or better, they'll contact first the investment banker for all the advice, and then decide if they're gonna contact it's called target company, okay? But a lot of times they may have one company in mind, but when you contact the investment bank might say, oh no, yeah, this company is good, but that company is much better, okay? And they'll say, we advise you to go for that company, not this one. Good morning. It's only 12, that's no big deal. All right, so finding merger partners, the investment bank will know the field. Some investment banks will specialize in oil and oil companies. Others will specialize in technology companies. So when one technology company decides to acquire another technology company, the investment bank might have a better idea about the synergies or the potential synergies with another company. So finding merger partners is a second. Number 3. Underwriting securities. Now, this appears to be part of function number 2. Look up there, investment banking, but it's slightly different. This is underwriting securities in a merger or in an acquisition. In other words, when there is a merger or acquisition, if there is a payment, well, there will be for sure a payment. If the payment will involve the issue of new stock or new bond, so you may go 2 ways about it. You may say, okay, well, we're gonna acquire the company, and I'm just picking a number, $1 billion, okay? And then you structure the payment. And the payment may be, let's say, $200 million in cash, and let's say $800 million payment in stock, okay? Well, the company doesn't have $200 million in cash. So the company may issue $200 million in bonds. It will get the cash from the bonds for a payment, and it will issue $800 million in, let's say, stock, and give it to the acquired company shareholders. So, however the payment will be made, if the company doesn't have all the cash available now, like Apple has, okay, they don't have the cash, and most major companies don't have the cash, new securities, whether new stock or new bond or convertible or whatever, will be issued, okay, and the investment bank will underwrite those securities. So that's extra business on top of the advice, okay? So they're going to get here advisory fees. Here they're going to get underwriting fees. So that's number 3. Number 4, which is part of number 2, will be target assessment. Or, okay, let's change the word assessment to valuation. Valuation. Target valuation means that the investment bank will, once the target is found and there is found to be good synergies, there's found to be a general value for merging or acquiring the company, the next question is, okay, we're gonna pay for you how much? So, number 3 will determine how we're gonna pay. It's actually number 4 maybe first determining what's the value. We're gonna pay $1 billion. So the investment bank will go through a special process. That particular process, which leads to valuing the company, is called due diligence. Due diligence. Due diligence is the process of verifying the accounting records in the target company and attempting to establish a proper, we call it fair value of the target company. So the whole process is called due diligence. It's not too different from if you're trying to marry someone, is basically to get to know them. You're not going to marry a stranger, right? Same thing, you want to buy a house, okay? You want to get to learn about the house. Does it have a roof leak? Is there a crime in the neighborhood? Okay, whatever the problem. So you want to find out what's going on in the house and around the house. By knowing what's going on in and around the house, you can determine better value. You don't want to buy the house and discover that 2 houses down the road there is a disco which got a wild, crazy noise until 3 o'clock and you can't sleep. That will be horrible for you, okay? Especially if you go early in the morning to work. Okay, so you want to find out those things beforehand. Next will be the merger agreement. Well, there's going to be before merger agreement, let's write another one. Negotiation. The investment bank will negotiate with the target company, first with the management, and will try to get the management to cooperate into a friendly takeover. Having the management to cooperate is very helpful, but it will be cost. You gotta pay those people. In other words, you gotta find their weaknesses, okay? And usually the weakness of all managers, corporate managers, is greed. Corporate managers are by nature greedy. As long as you offer them big money, millions, they'll accept and they'll come on board. So part of the investment banker is to bribe the managers at an acceptable price to turn them from hostile to friendly. As a general rule, if you're a manager, you always want to be a hostile in order to induce the bank and say, okay, will $5 million do it? And the manager say, well, I'll think about it. And then the investment banker comes back and says, okay, well, obviously, if we offer you 7, you won't think. And says, okay, $7 million good enough. Okay. So part of the negotiation is bribing the managers to cooperate into the deal. So, negotiation and merger agreement. This agreement means merger agreement, okay? So this becomes merger negotiation and merger agreement. Let's see what else we got. All right, well, that's number 6. Let me see where. Okay, I'll go here for number 7. What's number 7? Number 6 was mergers and acquisitions. Number 7 is back office. Back office and other functions, okay? So these are the 7 primary functions, of which on the final, the midterm, the next quiz, maybe the final, you'll need to explain market making, explain trading, explain any of these. I'll pick 1 or 2 of these to explain. So, what are the back office? All right, number 7, back office. Back office functions. Number 1, custody. Custody. Custody service. In a custody service, the bank will hold money and other valuable assets, bonds, stocks, gold, insurance, whatever, in favor of somebody else. For example, it could be in favor of the wife. And let's say the wife is not quite capable of doing investments and money and all the other things. So the bank might do that for her, okay? Or there may be a divorce going. Husband and wife got a whole pile of money in the investment bank. And now the investment bank will segregate, meaning separate the money for the wife and keep it separately from the husband. Or to hold it in custody in the sense that it will not allow the husband to take it all out. Even though the husband is the one and only who can take it out, in a divorce procedure, the bank will block him from doing that. So custody in any way is the bank holds certain assets for the benefit of somebody else. Well, that somebody else could be, let's say, the following case. That somebody else could be a child, 5 or 12-year-old child, whose parents just, let's say, unfortunately died. The parents had a big pile of money, and they're not just going to give it to an 8-year-old child. They will hold the money or assets, stocks, bonds, gold, whatever, in custody until the child matures legally and can legally control them. In other words, until the child turns 18 or 21, or whatever the law provides. So, custody service. Now, custody service is a little different from, again, this is law. It's getting complicated. That's why investment banks are into it. Escrow service. In an escrow service, you put money into an account which is intended and designed and will be paid for a third party, okay, and the bank will hold it in trust. The bank will hold it in trust. For example, there may be some kind of a down payment for a particular purchase, but you don't trust the seller. And let's say the purchase will be, let's say, $3 million. You got to pay upfront $1 million, but you don't trust the seller. You're not going to give the seller $1 million cash, and then the seller can disappear, okay? But you can give $1 million in escrow to the bank. The bank will hold it, and when the seller delivers the assets and the paperwork and the document and whatever else is to be done, then the bank will give them the money in escrow. Okay? So the bank will act as an intermediary trustee. Most people will trust the bank in this transaction. Because when the buyer and seller don't trust each other, especially when they're from different states or from different countries or different cultures or different religions or different nationalities, whatever the story might be, whenever they're in business, there's no trust. because you don't have a previous relationship. The bank could be that intermediate step to provide the trust, okay? Because the bank is supposedly more trustworthy. Of course, they'll do the custody service for a fee, they'll do the escrow service for a fee. So the bank will profit one way or another, and the bank will pocket 1% out of whatever the escrow account is. Now, an escrow account could be for taxes, where you put in your money, the money goes into the bank will hold it in escrow for tax authorities, the bank will use the money in the meantime, okay, that's part of the deal, but when the time comes, the bank will be legally obliged or obligated to make the payment, to make the tax payment. So it could be tax in escrow, possibly. In other words, this is money held in trust for a third party when some conditions occur. Maybe the time comes and the tax gotta get paid. Let's see what else we got. Okay, clearance and settlement. And settlement services. So, whenever you buy a stock or a bond, the payment clearance means that they gotta make a payment, and the settlement is the exchange of the payment for the asset. So 3 days later, the seller will give you the stock. So you take possession of the stock. So they may actually take hold of your stock. Now, you as a stock owner can actually walk to the investment bank and take your stock certificates and then take them home. Or you can lock them in a vault. Or you can take possession of your stock certificate and hold them in custody at the investment bank. In other words, you have your own shares, but instead of you holding it in your house, risking getting robbed, the investment bank will keep them in their safe deposits. Okay, so they could provide a custody service on top of the settlement service. Okay. Next, research. Could be, let's just call it short, investment. Research and advisory. Of course, could be merger and acquisition advisory or simply investment advisory. As in, Goldman Sachs says, we believe that gold is currently undervalued and good to buy. We believe that oil is extremely overvalued. There is too much supply, and there are currently hundreds and hundreds of tankers of oil, full of oil, sitting around Shanghai and Singapore, and they cannot deliver the oil, so the whole world oil market is oversupplied, and they may give you the advice to sell oil and, let's say, buy gold. Of course, they always advise you to buy stocks because they're in the business of selling stocks. They're always going to advise you to buy bonds because they're in the business of buying bonds. But in general, they provide one of these services. Let's see what else we got. Well, other little functions where they could be part of mergers and acquisitions is, let's write it in red, divestiture. Divestiture is a sale of a portion of a bigger business. For example, I may have a bank, and the bank may have a brokerage, and the bank doesn't want the brokerage, so they'll sell the brokerage division or the insurance division. Okay, so divestiture is a sale of a part of a company. And of course, they're going to find you, hopefully, a buyer for it. So they're going to help you price. So divestiture, in a sense, will be the exact opposite of a merger. In a merger, you're one company and acquire another company. In a divestiture, a big part of your company will be sold to whoever wants to buy it at whatever price. Let's see what else. Okay, well, they can do some loan trading. They could trade. Loan, not trade. Trading is a big difference. Loan trading. They can buy and sell loans and provide liquidity to the loan market. And I don't know where, I don't know how, it's not exactly anywhere. I don't kind of like see or remember. It is a big one. I've already discussed a lot of it. It's called securitization. Well, they'll create new securities out of existing securities. All right, so these are some of the back office. Let me see what else I have. So I'm done. Okay, well, the last piece which I have over here in investment banking to understand is that conflict of interest. Conflict of interest is probably one of the biggest problems in the financial industry today, as well as 50 or 100 years ago, is when someone with expertise, knowledge, and experience provides an advice and they can profit from that particular advice. So, for example, conflict of interest is they're doing the merger, they already have spoken with the management of a particular target company, another company comes along, wants to acquire A, but the investment bank says, no, you're going to be better off acquiring B, knowing that B, like the investment bank, is willing to be acquired, and B will pay a lot of extra money to the investment bank on top of A. In other words, if they steer the customer from A to B, the investment bank stands to profit a whole lot more. Another example of conflict of interest, a classic one everywhere, is between investment banking and brokerage. The investment bank will, let's say, as an example, issue stock, and then in the brokerage they will recommend and advise their brokerage customers, who will be lawyers, maybe doctors, or other engineers, other professionals who don't know and understand investing, and they'll listen to the, let's say, their broker advisor, and the broker advisor said, oh, we advise you to buy this particular stock. But if they advise you to buy this particular stock, first, you're helping the investment banking division, and second, you're generating brokerage fees. So by selling you the stock which they issue, the investment bank profits twice. Okay, not just once, but twice. And for them, it becomes a lot easier to sell the stock. So the investment banks love to do these things where they sell to their retail customers whatever they issue on the investment banking side. So that's a major conflict of interest, and the investment banking knows that whatever they're issuing or selling or recommending is a junk, but the brokerage says, oh, we recommend you, this is a great stock or a great bond or whatever it is. So this is a classic example of conflict of interest. Well, here is a more common sense conflict of interest that maybe you'll better understand. You don't understand too much about heart and heart disease, but you go to the doctor and the doctor says, oh man, you're in trouble. You need a heart surgery. We need to do this particular surgery for whatever reason. And if you don't do the surgery, maybe in 6-12 months, you're likely to die. If we do this surgery now, we're going to save your life. Well, the problem is you're not a heart specialist. You're not going to be able to appreciate, is it true or not true? And you decide to go with the surgery, which in the US is going to cost you $100,000. But in other countries a lot cheaper, like Thailand, it's still going to cost you $10,000 or $15,000, okay? Well, the problem is that when the surgeon says, or the doctor, the heart doctor says, we'll call him cardiologist, say, oh, you need this surgery, what he has in mind is if you agree that he will perform the surgery and he will make $100,000 from that particular surgery. So he gives you the advice, and then if you accept the surgery, he will profit and make a big pile of money out of it. Okay, so that's a great example of a conflict of interest. Well, conflict of interest is worse in two places. The financial industry, where they try to advise you, to give you advice for you to buy whatever they sell, and in the healthcare industry, where the doctor will profit from any kind of advice that they give you, because whatever the problem is, they say, oh, this is your solution, and then they'll charge you $100,000 or $10,000 or $50,000 for it. So conflict of interest is the biggest problem that you have to be aware of in finance. And that completes the chapter, and 10-minute break.